it's never been easier for business owners to look at their numbers themselves. With the likes of Xero and QuickBooks and other online accounting systems, you've got a lot of financial information right at your fingertips. So as long as your bookkeeper is on top of your financial admin, then there's no reason that you can't be looking at your own numbers. But understanding exactly what you're looking at and what you should be looking at is a bit more of a minefield. So when it comes to looking at your management accounts, a lot of business owners are getting more and more confident with looking at their profit and loss statement, but they're not quite sure how to understand the balance sheet. So today I'm going to give you 3 key numbers that you need to be looking out for in your balance sheet and exactly what impact those numbers will have on your profitability and also your cash flow. So when it comes to your balance sheet, in summary, your balance sheet shows you everything that you own, everything that is owed to you, and everything that you owe. So it summarises all of your assets and liabilities. Now, when it comes to some of the obvious numbers on your balance sheet, you can see your cash balance, you can see your creditors, which is all of the money that you owe to suppliers, and you can also see your debtors, which is all the money that's owed to you. But really, you're not going to find it that beneficial to just look at these big numbers on your balance sheet. You're going to be wanting to look at the more detailed reports, like your aged debtor report. And that is why a lot of business owners don't think that their balance sheet is actually useful on a regular basis. But I'm going to tell you 3 numbers that you should be looking at on your balance sheet because they will impact your profit and they will impact your cash flow too. So we're going to kick off with number 1, and that is accrual. Now, an accrual is essentially when you think that you're missing an invoice, you will put a accrual in, which means you put the cost into your profit and loss. So a really classic example of this is with utility bills. Now, typically utility providers issue these bills on a quarterly basis, but you are accruing costs on a monthly basis or every day because of your utility usage. So if you've got a really proactive accountant, what they'll be doing is they will be putting an accrual in on a monthly basis, estimating what they think your monthly costs are. And it's not just utilities this applies to. This could be literally any supplier that you work with that hasn't issued you an invoice for goods or services that you've had. A good accountant, a good management accountant or bookkeeper should be giving you a list of these on a monthly basis and making accruals. That way, your profit and loss is accurate on a monthly basis. But also when you look at your balance sheet, you will see the total amount of accruals there. Now, the reason why this is so important is because accruals is money that you owe to people. You just haven't yet had an invoice. And therefore, if you're trying to keep on top of your cash flow and understand what's likely to happen in the coming months, you really need to understand what accruals you've got and what missing invoices you've got. Now, the next crucial number that I think every business owner should be looking at on their balance sheet is prepayments. Now, prepayments is the opposite of accruals. Prepayments is where you have prepaid for something. Now, the most obvious prepayments that most businesses have are likely to be things like insurance, service charges, anything that you pay for quarterly like rent, things like that where you're paying in advance. Now, like I say, only proactive accountants tend to be doing this, but when you get a bill for anything that is annually or quarterly, they should be taking that bill and spreading the cost over the full period that it relates to. So if we're talking about a 12 months insurance bill, what you don't want to see is the full cost in your profit and loss on the month that you receive the invoice. You want to see that cost spread evenly across the 12 months that that insurance policy relates to. So what you will see in prepayments is everything that hasn't yet hit your profit and loss. So if your insurance bill starts in January and we're now in January, you will see 1 month's cost in January and 11 months cost will be sitting in prepayments, and you know that that's something that you have paid for in advance. It hasn't yet impacted your profitability, but you are committed to that cost and it will impact your profitability in coming months. So prepayments can be really crucial for understanding what your profit is likely to be if you're looking at your full financial year. But also from a cash flow perspective, prepayments is really interesting to understand because at the end of the day, this is all stuff where you have given money to a supplier for a service or goods that you haven't yet had. And of course, from a cash flow perspective, we want to be keeping our cash as long as possible. So ideally, we want our prepayments to be as low as possible. And the final number that I think is really crucial for all business owners to be understanding about their balance sheet is their equity balance. Now, equity is shareholders' funds in a business. Now, your shareholder funds increases by your retained earnings. Now, this is all of the profits that your business has made in prior years and you have not yet taken out of the business as dividends. And that's why I think equity is a really critical number that every business owner should know, because the equity is essentially the money that you could take out of the business as dividends. So of course, as a business owner, you want to be able to take maximum money out of your business and to make sure that you are getting a great return for the time and effort that you put into growing your business. So that's why I think equity is a really important number that every business owner should be aware of, because often in small businesses, what you will see is quite a large equity balance that has built up over the years because there just is not the cash flow to support taking higher dividends. And that's why you do need to keep an eye on your equity and make sure that if it is growing, that you're comfortable that the reason you're not taking those dividends is because you've made a proactive choice to reinvest those profits back into your business, rather than you just simply can't take the dividends that you want to take because you don't have the cash flow. So that's my take on 3 crucial numbers that every business owner should be looking at and getting value out of their balance sheet on a monthly basis. Like I say, your debtors, your creditors, you can get these reports easily out of most bookkeeping systems. And often the balance sheet is overlooked because business owners just don't know how valuable it can be. But as a management accountant and experienced finance director, I always start reviewing monthly accounts by looking at the balance sheet. I start with the balance sheet, I move on to the profit and loss, and then I look at the cash flow forecast. And I always follow that pattern, regardless of what size business I'm looking at. Do let me know what you think though. Are you reviewing your balance sheet on a monthly basis? Had you even considered that these numbers could be valuable and how you could utilise them? Let me know in the comments below, and if you've got any questions that you'd like me to help with.